At the FOMC meetings, members together set a target interest rate called the federal funds rate, which is the interest rate on overnight loans between banks. This rate influences other interest rates, like those for mortgage loans, and greatly affects the direction of the economy. To hit the Fed funds rate target, the FOMC issues a directive to the New York Fed's domestic trading desk, which will then buy or sell U.S. government securities on the open market. You're going to have to trust me on this one, but ultimately, this action of buying or selling securities affects how much money banks have available to lend to you and your family or business, and thus either increases, decreases, or maintains the growth of the money supply in the banking system. Speaking of the banking system, let's tag along with this bank examiner heading out to a commercial bank. To see what these guys do, you have to hit the road. As you might recall, Congress created the Federal Reserve to foster safe, sound, and competitive practices in the nation's banking system. To accomplish this, the Fed both regulates the banking system and supervises certain types of financial institutions. In case you're wondering, these types include state-chartered member banks, bank holding companies, which are the companies that own banks, and international organizations that do banking business in the United States. There are other types of banks that are supervised by other regulators. So, what's the difference between regulation and supervision? Bank regulation refers to the written rules that define what is acceptable behavior for financial institutions. The Board of Governors in Washington, D.C. takes care of this responsibility. Supervision refers to the enforcement of these rules, which is carried out by staff at the 12 reserve banks. Fed examiners, like those here, visit commercial banks and look over the bank's financial statements to evaluate the quality of assets, internal controls, and ability to manage risk. Now, why do you care? Because you've got money in this bank. The examiner's job is to make sure your money is safe and sound. Examiners also review a bank's performance in complying with federal and state laws. At the end of an on-site review, Fed examiners issue the bank a rating that reflects whether the institution is in good shape or whether it has weaknesses that require corrective action and close monitoring. One of the most important ways that the Fed ensures safety and soundness of the banking system is by helping banks respond to all kinds of crises. One way the Fed does this is by making short-term loans to banks through its discount window. This not only helps